Welcome to the TaxSlayer Pro Income Tax Preparation course, and this is Module 3. We're going to go over Part 1 of the income section for filing 2018 tax returns. Now I've broken up the income section because income is so broad. We've broken it up into 6 parts, and again this will be Part 1. So here we are on page 2 of the 2018 1040. Like I said in a previous module, the 1040 has been scaled down quite a bit, only 23 lines. And we are here right now in this section. And also we're going to talk about Schedule 1, additional income and adjustments to income. Alright, gross income. What's the definition of gross income? Well, all compensation for personal services is considered to be gross income. The form of payment is irrelevant. If services are paid for in property, then the property's fair market value at the time of the receipt is considered to be gross income. Income from self-employment is also included in gross income. Unreported compensation, for example tips, is part of gross income. Income, such as interest on savings, is received when it's made available to the taxpayer. Interest on savings is considered received when it's made available. So some of the types of income included in gross income: business income, compensation for services, fees, commissions, fringe benefits, gains from dealings in property, and interest, rents, and royalties, books, music, things of that nature, and dividends. Some other types of income included in gross income are annuities, pensions, partnership income, income from an interest in an estate or a trust, alimony. Let's take a look at the differences between taxable and non-taxable income. Well, non-taxable income, as you might expect, is excludable. It includes gifts and inheritances, insurance proceeds, sickness and injury payments, welfare payments, and food stamps. Taxable income, in this case earned income, is received for work such as wages on your W-2, business income, and unearned taxable income could be interest income from a savings account, stock dividends, or rental income. What about Social Security? Well, Social Security is considered unearned and a portion may be taxable, depending on other income that's reported on the individual's tax return. What about unemployment compensation? Well, unemployment is considered unearned, but it's all taxable. The total of earned and unearned income is considered to be gross income. So let's take a look at this little chart. Let's look at wages. Is it taxable? Of course. Interest, we just talked about that. Yes, it is taxable. How about child support? Non-taxable. Alimony, taxable for now, for 2018. Inheritance, non-taxable. Workers' compensation is considered non-taxable. Lottery winnings, yeah, you bet, they're taxable. Alright, I think we're all familiar with the W-2. The W-2 is typically issued to employees by January the 31st. W-2 reports wages and other compensation. Here's an example, 2018 W-2. The wages that get reported on the tax return are from Box 1. Now let's take a look at the codes and the amounts in Box 12 of the W-2. What do they mean? Well, the codes and amounts in box 12 of the W-2 are important for preparing a tax return. Some codes affect the current year income tax return. Other codes are simply there for information. Here's W-2 with a code D in box 12 and an amount of $700. Some of the more common codes that you'll find on a W-2 box 12. Code A represents uncollected Social Security or railroad retirement tax on tips. You include this amount as part of your total tax on Form 1040. Code B is uncollected Medicare tax on tips. We include this amount as part of the total tax on the 1040. Code D is non-taxable elective salary deferrals to a 401k plan. So that's what we just saw on that W-2. Code DD reports the cost of non-taxable health insurance provided through your employer. This is a fairly new code brought about by the Affordable Care Act. Code Q, non-taxable combat pay. Some individuals may elect to include their combat pay when calculating earned income credit. And Code J, non-taxable sick pay. This is for information only, typically not included in boxes 1, 3, or 5 of the W-2. So we enter the wages from box 1 of the W-2. They end up on line 1, page 2 of the 1040. Next, taxable interest and Schedule B. Taxable interest income includes interest you receive from bank accounts, dividends that are actually interest, mostly from credit unions. Credit unions typically call the interest on their accounts dividends. And CDs, certificates of deposit. Interest on insurance dividends is taxable. And interest you receive on tax refunds is taxable. Installment sale payments. If you sell a piece of land, part of the sale may be the principal and part of the sale may come across as interest. Now let's look at non-taxable interest. Interest on U.S. Treasury bonds and savings bonds are taxable on the federal return, but tax-free at the state level. Interest payments on most municipal bonds or muni bonds are tax-free at the federal level. What about interest from a traditional IRA? Well, interest earned on a traditional IRA is tax deferred. We don't include the interest in taxable income until we start making withdrawals from the IRA account. Interest income is generally reported on a Form 1099 INT. If the total interest received by the taxpayer is more than $1,500, then the interest must be reported on Schedule B. Part 3 of the Schedule B deals with foreign accounts and trust information. And Schedule B then transfers the amounts to line 2B on page 2 of the 2018 1040. Although tax-exempt interest is not taxable, it still must be reported on the 1040. And tax-exempt interest shows up in box 8, typically, of the 1099 INT. The tax-exempt interest gets used in calculating the taxability of certain income items, such as Social Security benefits. Some examples of tax-exempt interest include bonds that are issued by state and political subdivisions, county or city. For example, let's assume that David Shoemaker purchases a muni bond. The bond pays 5% interest per year, or $50 for every $1,000 that David invests. That $50 is income to him which is normally taxable. However, because municipal bonds are tax-free securities, then David's interest is tax-exempt. In some cases, the amount of tax-exempt interest a taxpayer earns can limit the taxpayer's qualification for certain other tax breaks. And again, municipal bonds are the most common instruments for paying tax-exempt interest. However, some interest from certain savings bonds can be tax-exempt as well. So tax-exempt interest shows on the Form 1040, page 2, line 2A. Next, let's look at dividend income and distributions. Dividends are distributions of money, stock, or property paid by a corporation. Most corporations use the Form 1099 DIV, Dividends and Distributions, to show the distribution income received by the taxpayer. And typically these ordinary dividends show up in Box 1A. Ordinary dividends then transfer to Part 2 of the Schedule B if necessary. Then they flow to page 2, line 3B on the Form 1040. On the 1099 DIV, you notice a number of boxes, some of which may have amounts reported and others that are left blank. Each box reports something different and affects whether you have to report it on the tax return as well as where to report it. Box 1A, total ordinary dividends, we talked about that. Box 1B reports qualified dividends. Box 2A reports total capital gain distributions. Box 3 reports non-dividend distributions. And Box 10 reports exempt interest dividends. Box 11 reports specified private activity bond interest dividends. Now, how do you know what to do with these amounts? Well, if you flip that 1099 DIV over, the instructions are there. Box 1A shows total ordinary dividends, and it also, the instructions that are given tell you how and where to report the amounts. Box 2A, report the amounts shown in Box 2A on Schedule D, line 13. Box 11 shows exempt interest dividends subject to AMT. This amount is included in Box 10. Here we're told to see the instructions for Form 6251. Box 1B shows the portion of the amount in Box 1A that may be eligible for reduced capital gains tax rates. Since 2003, certain dividends, known as qualified dividends, have been subject to the same tax rates as long-term capital gains. These long-term capital gains tax rates are lower than the rates for ordinary income. The IRS states that qualified dividends are dividends paid during the tax year from domestic corporations and qualified foreign corporations. For instance, this means that regular dividends paid out to shareholders of companies that are listed on the New York Stock Exchange are usually qualified, and they're taxed at the reduced capital gains tax rate. So here we see the qualified dividends showing up in Box 1B of the 1099 DIV. Qualified dividends flow over to Form 1040, page 2, line 3A. For example, assume that John owns 10,000 shares of Google stock, which pays 20 cents per year in dividends. In total, John receives $10,000 times $2.20 or $2,000 per year in dividends from Google. Because Google pays qualified dividends, John pays capital gains tax rates, let's say 15%, on the dividends rather than ordinary income tax rates, which could be 32% on the dividends. The most important thing to remember about qualified dividends is that they are a category of ordinary dividends that are subject to special tax rules that can save the taxpayer money on the tax return. In other words, all qualified dividends are ordinary, but not all ordinary dividends are qualified. Dividends then show up on Part 2 of the Schedule B, if the Schedule B is attached. And the $210 dividend that we previously entered adds to the qualified dividends from the new 1099 DIV. So we have an amount in box 3A of $34.99. That's our qualified dividends, but ordinary dividends, the total dividend amount, shows up in box 3B, $37.09. When qualified dividends are included in a taxpayer's income, then the income tax is calculated differently than under normal circumstances. Ordinarily, a taxpayer will pay taxes based on the figure obtained from the tax tables that are found in the Form 1040 instructions. So if we have taxable income of $36,349, the income tax showing here $35.64. Now remember, we have some qualified dividends, $34.99 on this tax return. So the tax from the tax tables is $39.78. The tax calculated on the return, $35.64. Why the difference? There's our taxable income. And from the tax tables, married filing jointly would be $39.78. When qualified dividends and capital gains are included as income on the tax return, the federal income tax is calculated on the qualified dividends and capital gain tax worksheet. So in this particular case, the $34.99, this amount is taxed at 0%. And most of the action, most of the calculations they take part in lines 26 and 27. 26 shows the tax from the tax table. 27 shows the tax because of the qualified dividends on the return. So in summary, all compensation for personal services is gross income. The form of payment is irrelevant. Non-taxable income can include gifts and inheritances, welfare payments, and food stamps. Social Security payments are considered unearned, but a portion of the Social Security payments may be taxable. This depends on other income on the tax return. Unemployment compensation is considered unearned, but it's taxable. Interest earned on a traditional IRA is tax deferred if the total interest income received on a tax return is more than $1,500. Then we have to attach Schedule B. Qualified dividends are a category of ordinary dividends that are subject to special tax rules. Income taxes are calculated differently when qualified dividends are included on a tax return. So now let's take a look at some review questions.